So this video is going to be walking you through Chapter 2, Problem 2-4 on page 87. It reads, Pender Corp paid $234,000 for a 30% interest in Salt Spring Limited on January 1st, year 6. During year 6, Salt Spring paid dividends of $100,000 and reported profit as follows. Profit before discontinuing operations, $288,000. Discontinued operations loss, net of tax, negative $30,000, and profit would have then been $258,000. Pender's profit for the year 6 consisted of $900,000 in sales, $400,000 in expenses, $200,000 pertaining to income tax expense, and its investment income from Salt Springs. Both companies had an income tax rate of 40%. So the required. It's sort of broken up into three different sections. The first one is related to the equity method, asking us to do all the journal entries, the correct balance in the investment account, and then an income statement. The same is expected for then the cost method, and then lastly, which option should they choose if they want to have the highest return on their income statement. So let's go and start with the first one, equity method. So under the equity method, I'm just going to jot this down so you can see what we're doing first. We need to record the actual investment. So let's go investment in Salt Spring. And we know we paid $234,000. Of course, we offset that with our cash for the same value. Next, we need to take a peek and look at our dividends. Now it says Salt Spring paid dividends of $100,000. It does not say it paid all $100,000 to Pender Corp. So what we need to do for dividends under the equity method is we take how much we received and record that. That is not how much they actually paid out. So in this case, we have our cash, and it will be 30% of the full $100,000. Now, under the equity method, we do not record it as dividend income. We record it as a direct offset to investment in Salt Spring. You can think of it this way. Remember back in Accounting 1 when we focused on, say, a proprietor pulling money out of his account, and it was treated as drawings, which was a debit to our retained earnings. It's very similar. So in this case, when dividends are being received from an investment company, we need to do it as a credit. So this one will be a credit, so it's investment in Salt Springs, because we need to show that the value is no longer there because we got $30,000 out of them. So let's just record our $30,000 in both our debit and our credit column. Next on the transaction list, we can see that they had a series of, profit, and then a discontinuing operations, and then a net position. So what we want to do here is we also want to record that on our side of things. This would not be done if you're going under the cost method, but with the equity method, we do want to record all of the different transactions. So first, we want to have that $258,000 for profit recorded as investment in Salt Springs. So for simplicity, I'm just going to copy and paste this, investment in Salt Springs. So our investment in Salt Spring is going to look something like this. We are going to have our 30% of their profit, which was $258,000. Under that, we also have our investment loss. So we need to record that, we didn't always make some money. So that will be treated as the same approach of 30% of the $30,000 loss. Now it's time to record our investment income. This will also be appearing on our income statement. You can do this one of two ways. You can either add up our investment in Salt Spring or an investment loss, or you can do $288,000 times our 30%. Either way, we come out to $86,400. So now it's time to sort of figure out our, quote, correct balance in our investment account at the end of the year. So let's start off with our investment as of, let's say, January 1. I'm just going to call it year 6. That is the amount we paid, so our full $234,000. Next, we receive some dividends. So our dividends will be a reduction of the investment of $30,000. After that, we have our share of income. And of course, with our share of income, we are only looking for transactions that hit our investment account. So if you're getting stuck onto which ones to grab, always look for investment in Salt Spring. Another way you could do this is also a T account. It works just the same. So our share of income in this case is going to be the $77,400. It is not our investment income that will be appearing on our income statement. We only want to have our investment in Salt Spring listed here to figure out our true balance, or our final balance of our investment account at the end of year 6. We are there. So let's go with our investment one more time. Oops, there we are. Go December 31, year 6, and now it's just going to be a sum of the above transactions. So we are going to be sitting at, I'm just going to bold it for you here, $281,400. So now it is time to move on to doing our income statement. So we have, it's for Pender Corp. Statement of operations, year ended December 31, and we'll say year 6. In the case, they gave us a lot of information. So they gave us our sales. Our sales were $900,000. Next, we have our investment income. Make sure you grab it from the right spot. It's going to be the $86,400 as we recorded up here. I'm just going to put that in red so you can follow along. Now we're just going to quickly create a net position of $986,400. Now it's time to have some of our expenses. So we have our operating expenses. This was also provided in the question of $400,000. Then we have our income before income tax, our earnings before tax is going to be $586,400. Then we have our income tax. We were told it was $200,000. Now we have our net income before discontinued operations. And this is going to be that $586,400 minus our $200,000. And I'll make it look pretty in a second. After that, we will continue on and get our discontinued operations investment loss in the mix. So discontinued operations, our investment loss, $9,000, and then it gives us our profit of the $386,400 minus our 9. So from here we can make it a little bit prettier and not have stuff so much cut off. This is our final check figure for our statement of operations profit. Now we can move on to the cost method. So for the most part, I am going to put it right beside here so you can see the difference between equity and cost. So we start off with our investment. This does not change between equity and cost. It is the same approach, at least for our initial investment. Next, for our cash, we will still get $30,000. That hasn't changed. However, what is changing is that we do not impact the investment account at all. Nothing for dividends, nothing for our investment income. Don't touch it other than our initial investment. Where do we want to book dividends? To dividend income. That's a new keyboard, can you tell? And try to figure out where all the different buttons are. So dividend income. We're good on that one now. That's it. We don't have anything like this. So I'm just going to copy it over just for the sake of showing it side by side and how they're different. The difference is we do not have any of this, right? So we really don't have any of these transactions. So easiest way to show it, I'm just going to do this. Block it out. Not there. How does our investment account look? Well, we didn't have any of these transactions, so let's just clear them. Our investment in the beginning is the same as our investment at the end. Now for the income statement, once again, it's easiest if we just copy it over. I'll make it a little bit more spread out. There we are. Now we won't have this transaction because you noticed it's missing from above. So let's just clear it. We also won't have our discontinued operations transaction in the mix. So let's just clear it out. Now it shows that we have 300,000. Well, that's not right because we did have an extra transaction up here that hasn't been recorded in our statement of operations. So instead of having investment income, let's go and record our dividend income. It's of 30,000. That is it, folks. That's the difference between our equity and our cost. Now, finally, under Part C, it basically asks, what's the preference if the person or the company wants to have the highest possible return? Well, as you can see, equity is yielding the highest return. Why? Because we're capturing our proportionate amount of our investments income on our income statement, whereas under the cost method, we're only capturing the dividend income. So if they are more aggressive and want to capture everything, then we will be suggesting the equity method. This wraps up problem 2-4 in Chapter 2. Thank you.